Hello everyone. In this video, we will compare 3 PSU companies using ratio analysis and different other investment metrics to evaluate which one is safe for investing for better returns in the future. At the end, we will estimate the CAGR to project the expected returns for a 1 lakh investment in these companies. Make sure to click the subscribe button and hit the bell icon for notifications so that you know exactly when the new content is released, as I have a lot of new content coming soon. Stay tuned. Right now, comment below on what next topics you want me to cover as I look at the comments to decide what videos to make. I really enjoy hearing from you guys. Let us have a general overview of these companies. So company 1 share price is at 31.85 rupees, book value 94.98, market cap 13,465.5, equity 4,130 crores, face value 10, last quarter sale at 16,541, stock price 1 year CAGR at minus 31.21%. Company 1 is Steel Authority of India Limited, also known as SAIL, which is the largest steel making company in India and one of the 7 Maharatnas of the country's central PSUs. It is in the steel sector. Company 2 share price is 33.35 rupees, book value 53.54, market cap 6,165, equity 932.81, face value 5, last quarter sales at 1,935 crores, stock price 1 year CAGR is minus 30.16%. Company 2 is National Aluminium Company Limited, also known as NALCO, which is a Navratna CPSU under the Ministry of Mines. It is in the aluminium sector. Company 3 share price is at 37.15 rupees, book value 17.63, market cap 3,340, equity 462.61, face value 5, last quarter sales at 93.29 crores, stock price 1 year CAGR is minus 3.88%. Company 3 is Hindustan Copper Ltd and also it's known as HCL, which is a government owned corporation in the central PSU under the Ministry of Mines, Government of India. HINDCOPPER is in the metal sector. When we evaluate strength of the company to generate EPS, earnings per share, for enabling strong price movement in the future, it has been found that for SAIL, it requires to show 4130.5 crores profit to generate 10 EPS for the given equity and face value. As most of you are aware, without generating EPS, the price won't sustain. So this company, SAIL, need to produce a profit of 4130.5 crores. Similarly, NALCO, it need to maintain profit at 1865.62 crores to generate 10 EPS. For HCL, it has to generate 925.24 crores to maintain that 10 EPS minimum. So this is a general overview about these 3 companies. Let's move to examine these companies' growth story. In this chart, you can compare 5-year revenue, EPS and DPS growth rate. Please note that ideally, there should not be many gaps in revenue and EPS growth. A company that has posted high revenue and EPS growth is a more promising company to invest in. DPS, that is the dividend per share, growth for SAIL and HCL is negative. Please note that this is not a dividend payout. It is the growth of dividend per share over the 5 years. So, NALCO has positioned well in these 3 growth metrics of revenue, EPS and DPS. Let's move on and see the 5-year DPS growth. Again, NALCO has positioned well in these 3 growth metrics of revenue, EPS and DPS. Let us move to examine the safety of our investment in these companies. The debt equity ratio is high for SAIL at 1.14, followed by Hindustan Copper at 0.92 and NALCO at 0.01 for the financial year 2019-20. The trend of this metric from 2007 to 2019 can be depicted from this graph. A high debt equity ratio is a bad sign for the safety of the investment. A company that has high debt in comparison to its net worth has to spend a large part of its profit in paying off the interest and the principal amount. If the debt is decreasing over a period of time, it is a good sign. Therefore, the companies which have a history of having taken lesser debt are safer investments. Further, if the debt equity ratio is high and company is showing good profits, most of the times the investors may not get the dividends. This ratio is called current ratio, which denotes the operating financial health of the company. It measures the capacity of the company to pay off its immediate liabilities with the immediate liquidable assets. Current assets include cash, short-term investments, receivables, inventory, etc. A current ratio of 2 is considered ideal. Companies that have a current ratio of less than 1 should be avoided. The current ratio is high for NALCO at 1.93. It's a good thing and a good sign, followed by Hindustan Copper at 1.29 and SAIL at 0.78 for the financial year 2019-20. The trend of this metric from 2007 to 2019 can be depicted from this graph. Moving ahead, all these three companies have zero share pledging. Pledging the shares denotes that there is something wrong with the company, as it is usually the last resort used by the promoters to raise money. Avoid companies with more than 5% pledge. Stock dilution is one of the important factors to be kept in mind while investing. A company may be earning huge profits and may be distributing a high dividend. However, if it keeps issuing more shares, that would dilute your ownership of the company. NALCO equity has been reduced from 1288 crores to 932 crores in the financial year 2017-18. So stock dilution is negative here and it is considered as a good sign. SAIL is at 0% and HCL at 20.4%. Let us move to examine the performance of these companies. Return on equity is the measure of the efficiency of the company at generating profit with respect to its net worth. A company that has a high return on equity is likely to grow faster in the future in comparison to one that has lesser return on equity. It is advisable to target companies that have ROE greater than 15%. The ROE is high for NALCO, followed by HCL and SAIL. In this figure, you can notice that SAIL's ROE has turned to positive from negative in the last financial year. Net profit margin is the measure of how much of the company's revenue actually translates into profit after covering all expenses, interest, tax, etc. If company A has a higher net profit margin than company B, both belonging to the same sector, it means that company A is able to generate a higher amount of profit with respect to cost in comparison to company B. It also means that company A has a competitive advantage over company B, due to which it is able to maintain a higher net profit margin. Here, NALCO has a high net profit margin as compared to HCL and SAIL. In this figure, you can notice that SAIL's net profit margin has turned to positive from negative in the last financial year. Let us move to examine the valuation of these companies. Valuation is the analytical process of determining the current or projected worth of a company. There are many techniques used for doing a valuation. A valuation can be useful when trying to determine the fair value of a stock, which is determined by what a buyer is willing to pay a seller, assuming both parties enter the transaction willingly. As stock trades on an exchange, buyers and sellers determine the market value of a stock. As earnings for SAIL and HCL are negative, the general valuation models are not applied. However, for NALCO, PE valuation at rupees 11.32, Graham's number at rupees 30.59. If you observe carefully, the current price is more than the Graham's number. Usually, investors sell the scrip when it is more than the Graham's number. However, the DCF valuation is around 209.97. Let us understand, here the discounted cash flow model or DCF model is a type of financial model that values a company by forecasting its cash flows and discounting the cash flows to arrive at a price. So if any turnaround or a piece of big news happens to here in the NALCO, then there is a possibility for the stock to move up to rupees 200 levels based on the market momentum. There is a lot more detailed analysis to present here. However, it is out of the scope for this video. Let us compare these companies with some key metrics and conclude this video with my opinions. SAIL is having high market capitalization and low PBV ratio. The PBV ratio is the market price per share divided by the book value per share. The market price per share is simply the stock price. The book value per share is a firm's asset minus its liabilities divided by a total number of shares. Investors look for low PBV companies along with other metrics. NALCO has dominated in the metrics such as debt equity ratio, EPS growth, average ROE and dividend yield. The key summary highlights in each of these companies are as follows. For SAIL, stock is trading at 0.34 times its book value, contingent liabilities of around 30,000 crores. For NALCO, stock is trading at 0.62 times its book value. Promoter holding has decreased over the last 3 years by 13.86%, a point to be noted here. For HCL, healthy dividend payout of 30.66%. Company has a low interest coverage ratio, which is a bad sign. Let us see the expected returns with the estimated CAGR for each of these companies. The estimated CAGR for SAIL is 32.8%. I will make another video on the estimation of the CAGR, which is not the topic of this video. For rupees 1 lakh investment, we can expect a return of 17,06,006 rupees for a period of 10 years. This is a high risk, high return scenario for this company, which is exhibiting the technical ratios as explained earlier. The estimated CAGR for NALCO is 11.6%. For rupees 1 lakh investment, we can expect a return of 2,99,669, which means around 3 lakhs. This is a low risk, moderate return scenario for this company, which is exhibiting the technical ratios as explained earlier. The estimated CAGR for HCL is 6.1%, subject to turnaround by 2020-23, since in the last quarter it has posted a bad result. For rupees 1 lakh investment, we can expect a return of 1,80,781. This is a moderate risk, low return scenario for this company. Investments in stock markets are risky. You may lose your capital partially or fully, but if you are successful with this strategy, your returns will be higher compared with the bank FD. With the strategy of splitting 1 lakh capital in 2:2:1, that is 40k, 40k, 20k in these three companies, that is SAIL, NALCO and Hindustan Copper, returns can be projected up to rupees 4.3 lakhs. So this is the calculations which I made to make you aware about, for example, my opinion on these three stocks. If I have 1 lakh, I'll be dividing it in the ratio of 2:2:1, that is 40k, 40k, 20k. Investing money into the markets has a high degree of risk, and you should be compensated if you are going to take that risk. Happy investing. Thanks for watching. I'm new on YouTube. If you like this video, make sure to subscribe for more. I'll see you again in the next video.